In this quarter, there were some continuations of long-term themes that we've been talking about for some time, plus some surprises. First of all, focusing on Australia, it was the August reporting season when I think the best sort of way to describe it is a divergent performance results. Some companies outperform expectations. However, there were a number of companies that performed below market expectations. And in fact, at the broad Australian market level, there were more companies performing below expectations than has been the case for some time over the last 10, 20 years. Turning attention to the more global picture, then global growth became more solid across regions, and as a result, the commodity markets, both iron ore and oil, continued to rise on the back of this, helping the resources and energy companies. In the currency markets, the response to a statement from the Reserve Bank of Australia in July was, in our view, taken out of context with respect to the long-term neutral rate in Australia. The rise in the Australian dollar relative to most currencies in this market, we feel, is a temporary phenomenon and will be reversed over the longer term. And therefore our view towards being unhedged continues to be supported. And lastly, in terms of central bank action, while the Federal Reserve made no change to their cash interest rate as expected in the September meeting, what they did signal was that the combination of both an October start to the tapering of their balance sheet with continued increases in interest rates expected is taking the Federal Reserve into uncharted territory in terms of the withdrawal of stimulation. We think this will be significant in terms of the impact on market valuations going forward. Well, as I mentioned, the August reporting season had some fairly negative results in there, and at a broad level, expectations were not high. And also this calendar year, the market has basically been stagnant at about the same level prior to dividends. So there's a number of things going on in there which we feel really support the approach of an active management approach and also a long-term contrarian approach to finding the right securities. So first of all, we are underweight the Australian equity market compared to the global equity markets. And within the Australian equity market, we are tending to focus our overweight views on companies that have the highest chance of outperforming low expectations from the market. So examples of these are Medibank and Platinum, that going into the reporting season had very low expectations, and yet while their results were not stellar, they actually outperformed those expectations, and the share price has been positive as a result of that afterwards. On the flip side, many of the companies in Australia that were high dividend paying, high payout ratio companies, of course, the banks and Telstra being examples of that, have started to struggle as their models of business cannot sustain the continued high payout ratios. So we continue to be fairly underweight those higher dividend paying companies and looking for share price growth in some of the beaten up sectors of the market. We really are in uncharted territory. A combination of very high market valuations for both equity and bond markets, combined with global growth that's solid but not stellar, and the fact that central banks are beginning to unwind that very large policy stimulation that's been in place for the last decade. As we mentioned earlier, the Federal Reserve have signalled that starting in October, the tapering of their balance sheet, and yet expectations of further increases in the interest rate into 2018 mean that we're entering sort of that part of the market where that stimulus is going to be removed, and the impact on equity and bond valuations is going to be very much tested. I think of the most concern is the fact that the lack of volatility seems to signal that investors are complacent, and the combination of market valuations and investors' complacency can in some cases lead to very big distortions in price and valuation. In this environment, we continue to focus on producing long-term sustainable returns for our investors through our multi-asset portfolios. That means a combination of high conviction positions that are in some cases contrarian, in some cases different to the SAA-based approach. We continue to be overweight emerging markets and underweight the US equity markets, we continue to focus more on the Australian bond market rather than the global bond market. And we've really reduced our exposure over the last 12 months to property through the listed property trust market. Currency hedging is going to be very important as we head into the next 12 months. We think that the Australian dollar as a general proxy for positive sentiment in the market and global growth is going to be tested, and we therefore maintain a very high overweight to non-Australian dollar currencies, including the emerging markets, the pound sterling and the US dollar. We think that going forward, low single-digit returns is going to be the norm, and therefore a focus on keeping taxes and costs low is important for our portfolios to achieve our objectives, and a focus on high conviction active management.